Good morning, Bénédicte. Thank you for coming to our studio. Welcome.
Thank you.
The first question I had really was on oil prices. We've seen such volatility on oil prices this year. How is that impacting inflation? Is inflation still a major issue for investors, or are we starting to see signs of stabilization?
First off, oil prices have, of course, come down quite quickly and have been coming down since in the middle of May. And that's, of course, linked to the agreement between the US and Iran, but also because we've had additional supply of oil coming from the US and other areas and less demand, especially from China. And so that has appeased market concerns globally, and with this agreement on top of that. So that is good news for inflation, of course. Energy prices explained about a third of euro area inflation, so mechanically that will bring inflation down. Now there's still some worries on food prices, notably, that will take time to normalize. There's also some worries on electricity prices in the US linked to AI demand. But globally, we don't think that labor markets are strong enough to create these second round effects where prices go up, it impacts wages, and therefore it impacts prices. There's kind of this vicious circle that comes into mind. That's not the case. It's not like after the pandemic. And so we think that inflation will come down in 2027 to meet central bank targets.
Okay. And talking about central banks, we had the ECB raising interest rates by a quarter of a percentage point, and you have a new chairman at the Fed. Mm-hmm. How do you see American and European monetary policy diverging from here, and what kind of impact could that have on global markets generally?
Well, I mean, for the ECB today, it's obviously a delicate situation. They've reacted quickly. They want to calm inflation expectations. And that was initially why we thought that they would hike again in July. Markets think they will hike in September. We're not particularly comfortable with that idea that the ECB will wait until September. We think they will either hike in July or they won't hike at all. So that's the ECB. For the Fed, of course, the new chairman, Kevin Walsh, was, of course, more hawkish than what markets were expecting. And I think that was good for the credibility of the Fed with all these questions about the independence of the Fed, et cetera. Going ahead, do we think they will hike in the current context, given that we think that this inflation period is temporary? We don't think they're going to hike in 2026. We think they might actually cut in 2027.
So, focusing now on emerging markets, the recent macro data coming out of China has been and continues to be quite subdued. We have a positive view on emerging markets generally. Mm-hmm. Can you just explain the drivers behind our positive view, given that Chinese data has been quite weak?
Yeah, well, there's kind of four drivers. First off, China has had these technical factors linked to the fact that they had a fiscal stimulus in 2025, 2026 a little bit less. So we think there will be a form of reacceleration in Chinese growth towards the third quarter. AI continues to be a factor that's supporting the region as a whole. Now, of course, we talk a lot about South Korea and Taiwan, but this should broaden out to the rest of the emerging markets. We believe the dollar will remain relatively weak after this geopolitical period, and that's supportive to emerging markets. And we also believe that emerging markets were the first ones, especially in Asia, to really be impacted by the Iran conflict. And so going ahead, they should be the first ones to benefit from the reopening.
Given this chaos that we've seen in 2026, there's been so many changes, and I'm sure it's impacted the strategy. How is the strategy positioned today? How are you preparing to mitigate future risk and seize investment opportunities over the coming quarters?
Well, I'd say that our investment strategy has been very much remain invested. Look through the noise, and that has paid off given all the geopolitical noise that we've been having. We're focusing on the fundamentals. The fundamentals are improving, with petrol prices coming down, inflation as well. Growth should improve. So this is positive for markets. That's one fundamental. As well, in the tech sector, there's a lot of talk, of course, noise around the tech sector. If you look at the earnings, the progress in earnings supports the performance of markets. And as long as markets are following these earnings, and it's not, the opposite, where market performance is outperforming earnings. So we want to stay, but we're in this optic today where earnings are growing faster in the tech sector than market performance. So we can remain confident on the tech sector. And then finally, so of course we prefer the US and emerging markets. And overall, we continue to look at the overall investment cycle. We've published 2 articles in the Monthly House View on this topic, and how this investment cycle will continue, focusing on electrification, focusing on strategic autonomy, focusing on AI, and that's positive for the economy, and it will be positive as well for markets going ahead.
Okay, so globally, a very positive message. It remains so, even with the changes that we've most recently seen.
Well, I mean, there's obviously risks that we monitor, but overall, yes, this is a good news, and it's going in the right direction.
Thank you so much, Bénédicte, for talking to us today and taking the time. If you would like to consult any other of our analysis from our other experts, please consult our Monthly House View.